60.8. That's the gold to silver ratio right now, today, as of this morning, March 13th, 2026. And if you've been watching this market for any length of time, you know exactly why that number should make every single silver holder stop what they're doing and pay very close attention. Because that ratio just spiked. Hard. And at the exact same time, according to the latest CFTC commitments of traders data, that's the official federal filing that every large institution is legally required to submit, commercial short positions in silver futures sit at approximately 70,859 contracts. Let me repeat that. Nearly 71,000 contracts shorted on the commercial side alone, and that's on top of roughly 10,888 non-commercial short contracts. We're talking about a wall of paper silver pressing down on this market right now, today. Meanwhile, physical silver is sitting at around $84.41 per ounce this morning. Gold is at approximately $5,093. You do that math. Divide those two numbers and you get 60.4, 60.8, depending on the minute you check. The point is, the ratio spiked sharply after silver's recent correction, and that spike is telling us something that most people watching this market are completely missing. Now, before I go any further, I need to give you the full picture of what's happened over the last 60 days, because without that context, today's ratio spike is just a number. With it, it becomes one of the most significant signals in this entire silver bull market. So stay with me here, because by the end of this video, you're going to understand exactly what a ratio spike combined with a massive short position buildup actually means for where silver goes next. And it's not what the bearish crowd is telling you. Let me set the scene. At the start of 2026, silver did something it hadn't done in decades. It broke through $100 an ounce for the first time ever, briefly touching $121.67 on January 29th. The gold to silver ratio compressed all the way down to around 43. The last time the ratio was that low was 2012, over a decade ago. Then, almost immediately after that historic high, silver crashed. Hard. A 36% collapse in days. And that's where today's story really begins, because what happened during and after that crash is exactly the kind of institutional fingerprint that reveals what's actually going on underneath the surface of this market. Quick note for those who aren't subscribed yet. My analytics show roughly 3 out of 4 people watching aren't subscribed. If this kind of data-backed, no-hype analysis is cutting through the noise for you, hit subscribe right now. That's how I know who the serious community is. It helps me, it helps the algorithm show this to more people who genuinely need to see it. Okay, back to the ratio. Here's what makes the current setup so historically loaded. According to data published by the Silver Institute on February 10th of this year, 2026 is expected to be the 6th consecutive year of a structural supply deficit in the silver market. Total demand is set to exceed total supply for the 6th year running. The Silver Institute confirmed that silver mine production is expected to reach about 820 million ounces this year, while total demand continues to outpace that by a substantial margin, with industrial applications alone consuming roughly 59% of all silver produced globally. Solar panels, AI data centers, electric vehicle electrical systems, all of it running on silver. And yet here we are. The ratio just spiked back towards 61, silver got hit with a wave of short contracts, and the mainstream financial press is barely covering it. So let's talk about what that actually means. The gold to silver ratio is the most powerful tool in the precious metals investor's toolkit when you understand how to read its extremes. And I mean understand it at a deep level, not just buy when it's high, sell when it's low. Let me show you the historical pattern because this is where it gets genuinely alarming. Here are 3 documented instances where the ratio spiked sharply after an initial compression move, right before silver exploded higher. In 2008, the ratio hit 84 during the financial crisis. Silver was crushed along with everything else. Then over the next 3 years, silver went from about $9 an ounce to $49.80, a 450% move. 450% from the ratio extreme. In 2016, the ratio spiked back up toward 80 after a brief compression. Silver then ran from the low teens all the way back toward $30. And in 2020, during the COVID crash, the ratio hit nearly 124 to 1, the highest reading in modern financial history. Silver was at $12. Within 18 months, it had tripled. Every single time this ratio has moved to an extreme and then started reversing, silver has produced some of the most violent upside moves in any commodity market. Now, 61 is not 124. It's not 84. But here's what's different about right now. In 2008, in 2016, in 2020, there was no structural supply deficit. There was no sixth consecutive year of demand outstripping mine production. The physical market was not draining at the pace it's draining today. The COMEX wasn't seeing vault drawdowns where 26% of registered inventory disappeared in a single week. This cycle has an entirely different foundation beneath it. Let me talk about the short position, because this is the smoking gun in today's setup. The CFTC's Commitments of Traders report, with data as of March 3, 2026, this is public federal data you can verify yourself at cftc.gov, shows total open interest in silver futures at 113,326 contracts. Each COMEX silver futures contract represents 5,000 troy ounces. On the commercial side, and I want you to understand who commercials are, these are the big banks, the bullion dealers, the large institutions that use futures to hedge. Their total short position is 70,859 contracts. Their total long position is only 30,893 contracts. That is a net short of roughly 40,000 contracts on the commercial side alone. At 5,000 ounces per contract, that represents approximately 200 million ounces of paper silver sold short by commercial entities. Now here's the piece most people miss. Between the reporting date of February 24th and March 3rd, open interest dropped by 12,128 contracts. That means long liquidation was happening aggressively during that window. People were bailing out of longs. And who benefits when longs bail out and price drops? The shorts. Think of it like a game where one side of the table knows the dealer is about to stack the deck. StoneX, one of the most respected commodity research firms in the world, they have access to 40-plus derivatives exchanges globally, put out their latest COT analysis as of March 10, 2026. They noted that large speculators have trimmed net long exposure in silver to a near two-year low of approximately 22,000 contracts. A two-year low. Meanwhile, silver prices have been in a general uptrend on the longer-term charts. Think about that for a second. Price is still historically elevated. The structural bull case is intact. And yet speculative long positioning just hit its lowest level in 2 years. That is a classic washout setup. The weak hands have been shaken out. The people who chased the $121 move and got stopped out are gone. The momentum chasers are gone. What's left? The committed physical buyers and the commercial shorts, facing off in what could become one of the most consequential squeezes this market has seen. And then there's the ratio spike itself, which brings me to what happened in the last 2 weeks specifically. Silver went from its January high of $121.67 to a low somewhere around $72 to $75 during the crash. Then it bounced. Hard. It recovered to around $83 to $85 where it sits today. But during that recovery, gold held up far better. Gold went from around $5,400 before the crash, dropped to roughly $5,070 at the worst, and has since recovered to above $5,100. So gold lost less and recovered faster. Silver lost more and recovered slower. That gap, that relative underperformance of silver versus gold, is exactly what pushed the ratio back up towards 60.8. And here is where the historical pattern becomes almost uncomfortably precise. Every single time since 1980 that silver has dramatically outperformed gold, crashed, underperformed during the recovery, and allowed the ratio to spike back up. That ratio spike has marked not the end of silver's bull market, but a coiling of the spring before the next explosive move. Gold-silver's data going back decades shows that when the ratio moved back above 80 after a compression move, silver subsequently rallied 40%, 300%, and 400% in the three most recent instances. We're not at 80 right now, we're at 61. But the direction of the ratio move, from 43 back to 60, combined with the short buildup and the structural deficit, that tells a very specific story. Let me show you the physical market because this is where the paper story and the real-world story completely diverge. According to analysis published in Trading Key on January 19, 2026, in just 7 days during early January, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. 26% of COMEX's entire registered silver inventory. Gone. In 1 week. Seeking Alpha published data as recently as late February, showing that registered silver stocks had fallen to approximately 86 million ounces, a 31% decline from levels seen just months earlier. And this data point from Seeking Alpha is crucial. The metal that left registered didn't flow into eligible. It left the vault entirely. It's not sitting somewhere waiting to come back. It's gone into the hands of whoever took delivery and chose to physically remove it. Now compare that to the paper market. You have 70,000 plus commercial short contracts. You have open interest of 113,000 contracts. At 5,000 ounces per contract, That's 565 million paper ounces of silver interest, versus roughly 86 million ounces of registered physical metal. That's a paper-to-physical ratio of more than 6 to 1 on a very generous reading. The actual deliverable pool, the metal that's unencumbered, fully warranted, and available for immediate delivery, is likely considerably smaller than even that 86 million ounce figure. This is not conspiracy theory. This is documented warehouse data and open interest data from official exchange filings. You can verify every number I'm giving you. Now I want to walk through what a short squeeze in this environment actually looks like mechanically, because most people think it's simple, and it's not. Here's how the trap gets sprung. The commercial shorts need silver prices to stay subdued or fall further to make money on those positions. They have 70,859 short contracts. If silver rises even $5 an ounce, each contract loses $25,000. Multiply that by 70,859 contracts, and you're looking at $1.77 billion in losses from a single $5 move. $5. On a metal trading at $84. That's a 6% move. These institutions have deep pockets. They can absorb that. But they cannot absorb a sustained multi-month grind higher in silver combined with continued physical drain from the COMEX vaults. Because at some point, someone holding a futures contract decides they want the physical metal, not the cash settlement. And when that happens at scale, like we saw in January, the math starts to break down. Bill Holter, the senior precious metals analyst, warned back in early 2026 that March delivery demand could test COMEX in ways that hadn't been seen since the Silver Thursday event of 1980. Registered inventory was running at 110 to 120 million ounces at the time of his warning, with open interest implying delivery demands that could reach 70 to 80 million ounces in a major delivery month. While the most catastrophic default scenarios haven't materialized, the underlying tension he identified, massive paper exposure sitting atop a shrinking physical base, hasn't gone away. It's gotten worse. Let me talk about the SLV short interest because this is another dimension that most people aren't tracking. TradingView analysis published in late February noted that the iShares Silver Trust, ticker SLV, had record short interest sitting in the market. That means institutions are not just shorting silver futures at COMEX, they're also shorting the silver ETF. If silver prices rise, those ETF short sellers face margin pressure forcing them to cover, which means buying SLV shares, which means the ETF has to acquire more physical silver, which puts more pressure on an already strained physical market. It's a mechanical feedback loop that gets triggered by price rising. And according to Bank of America's head of metals research, Michael Widmer, whose gold to silver ratio analysis was published approximately 2 weeks ago, the ratio currently at around 59 to 61 means that at gold's current price near $5,100, silver would need to reach $135 just to hit the 2011 ratio low. The $135 target is Bank of America's base case, not the extreme, the base case. Here's what makes this truly alarming from a timing standpoint. Look at the macro backdrop sitting underneath silver right now. The Federal Reserve is holding rates at 3.50 to 3.75%, according to CME data, with 95.6% of market participants expecting no change at the upcoming March 18th meeting. Markets are now pricing in rate cuts beginning possibly in September. According to Light Finance's analysis from March 12th, gold is expected to keep trading in the $5,100 to $5,200 range near term, with geopolitical tensions in the Middle East, specifically the ongoing Iran conflict and threats around the Strait of Hormuz, continuing to drive safe haven demand. When safe haven flows go to gold, silver eventually follows with more leverage, always has. This is not a new dynamic. Meanwhile, you have the structural supply picture. Silver mine production from Fresnillo, the world's largest primary silver producer, was already cut for 2026. Their guidance dropped from 45 to 51 million ounces down to 42 to 46.5 million ounces. That's a reduction of up to 4.5 million ounces from the largest single silver producer on Earth. Mexico and Russia together account for roughly 20 to 21% of global silver production. Both have elevated geopolitical and trade risks. China's export licensing restrictions on silver, which went into effect January 1st of this year, remain in force. So let me show you the disconnect, because this is where rational people start to question what the market is actually pricing. You have a market that has been in deficit for 6 straight years. You have physical metal draining out of COMEX vaults at an unprecedented pace. You have the largest silver-producing country cutting output guidance. You have China restricting exports. You have industrial demand from AI data centers, EVs, and solar that is structural and doesn't disappear. And sitting on top of all of that, you have 70,000 plus commercial short contracts pressing down on the paper price. Citigroup analysts have suggested silver could find a stable floor between $65 and $75, per analysis published approximately 2 weeks ago, provided the structural supply deficit remains intact. Note what they said, if the deficit remains intact. But the deficit is the most documented, most verified, most institutional consensus part of this entire story. The Silver Institute has confirmed it for 6 consecutive years. You don't get a 6th straight deficit year by accident. The paper market is telling you one thing. The physical market, vault drawdowns, lease rates at elevated levels, physical premiums holding up, Asian markets paying above spot, is telling you something completely different. When those two things diverge this dramatically and for this long, history shows us which one eventually wins. And it's not the paper. Now I want to name the key numbers you should be watching from this point forward. First, the gold to silver ratio. If it pushes back above 65, that would historically represent an extreme undervaluation of silver that almost always precedes a violent reversion. If it starts compressing back toward 55 and below, that's the market telling you the second leg of silver's move is beginning. Watch this ratio like your financial life depends on it, because in a real sense, your positioning decisions do. Second, COMEX registered silver inventory. The current level around 86 million ounces is already at a level where serious analysts are starting to use the word stress. If it drops below 70 million ounces, that is a legitimate alarm signal. If it approaches 50 million ounces, a level seeking alpha identified as the threshold where physical supply stress becomes acute, then the paper-to-physical gap we've been talking about stops being theoretical and starts being a real-time crisis. Third, the commercial short position in the COT report. Watch for any week where that position starts declining rapidly. That means short covering. That is institutional money buying silver futures to close out their short positions. That is rocket fuel for price. Fourth, SLV short interest. If that record short position starts unwinding, the mechanical covering process I described earlier kicks in and amplifies every move to the upside. What does this mean for you personally? Let me be very direct here, and I want to be clear that nothing I say here is financial advice. I am not a financial advisor. This is analysis and education only. Your specific situation is different from everyone else's and requires consultation with a qualified financial professional. That said, here is what the data is showing you. If you currently hold physical silver, bars, rounds, coins, the current ratio spike and price pullback from January's highs does not change the structural story. Not one piece of the bull case has been negated. The deficit is larger than ever. The COMEX inventory is smaller than it was. The shorts are more concentrated than they were before January. What changed is that a speculative bubble got flushed out. People who bought at $110 and $120 chasing momentum got stopped out. The structural buyers, the ones who understand the supply-demand math, are still accumulating. If you're thinking about adding physical silver, the ratio at 60.8 represents a historically advantageous entry point relative to gold. That is not hype. That is documented, verified math. The last 3 times this ratio was elevated and then began compressing, silver outperformed gold by a factor of between 3 and 5 over the subsequent 12 to 18 months. If you hold silver ETFs like SLV, understand the distinction between that and physical metal. An ETF is a paper claim. The record short interest against SLV means institutional players are actively betting against it in the paper market. Physical metal doesn't have that counterparty risk. And if you've been sitting on the sidelines trying to time the perfect entry, here is the uncomfortable truth that history gives us. Nobody who bought physical silver at $15, $20, $25 cares about the $84 to $121 round trip. They care about where silver is in 3 years. And with a 6th consecutive supply deficit, with COMEX vaults draining, with Bank of America projecting a base case of $135, the only question worth asking is not, is $84 a good price? But what does 6 more years of structural deficit do to a market that's already this tight? Let me bring this full circle because I want you to leave this video with a very precise mental model of what is unfolding right now. 60.8, that ratio number I opened with. You now understand what it means. It means silver got smashed during January's liquidation. It means gold held up relatively better. It means the ratio spiked as silver underperformed. And it means, based on every historical precedent from 2020, 2016, 2008, and 2003, that what looks like weakness is actually the market setting up for the next leg. But this cycle is structurally different from every prior cycle in one critical way. Every other time the ratio spiked, the physical market was broadly in balance. Today, the physical market is 6 years into a documented structural deficit. Today, 33 million ounces physically left COMEX in a single week. Today, Fresnillo is cutting production guidance. Today, China has restricted exports. Today, Bank of America is projecting $135 to $309 per ounce. Today, the commercial shorts are sitting on nearly 71,000 contracts. The institutions that control this market are intelligent. They know the physical supply story. They know the deficit math. And the fact that they still maintain this level of short exposure tells you one of two things. Either they have a plan to manage the physical delivery problem, or they are sitting on a position that will eventually become unsustainable as vault inventory continues to drain. History, every time we've been in this situation, says the latter is what unfolds. The paper eventually yields to the physical. It always does, every time, without exception. In 1980, the Hunt brothers cornered the silver market, and the ratio collapsed to 14-1. Regulators changed the rules in the middle of the game to stop them, and silver crashed. But before the intervention, silver had run from $6 to $49, over 700%. The warning signs were there for years before the move. People who were paying attention to the physical supply and the paper-to-physical ratio made generational wealth. The people who dismissed it as noise missed the entire move. In 2011, silver tripled in 18 months, while gold rose roughly 80%. The people who had been watching the supply deficit, the industrial demand from solar and electronics, and the ratio, they were positioned. The people who thought silver was just gold's lesser sibling missed a 200% move. Today's setup is not identical to either of those. It's more complex. It's more institutional. The industrial demand component is larger than it's ever been. The deficit is larger than it's ever been in the modern era. And the paper-to-physical tension is tighter than it's been since at least 2011. The signs are here. The data is documented. The sources are public. CFTC filings, Silver Institute reports, COMEX warehouse data, COT reports, Bank of America research notes. None of this is speculation. All of it is verified. The only question is whether you're paying attention. Drop a comment below and tell me this. At the current ratio of 60.8, with silver at $84 and gold at $5,100, are you adding physical here, waiting for the ratio to push higher before you act? Or do you think the January spike to $121 was the blow-off top, and this bull market is done? I read every single comment. Your perspective directly shapes what I cover next, and I want to know where this community stands right now. And if you haven't subscribed yet, there it is again, right now. Hit it. This kind of data-driven analysis takes real work to put together, and the algorithm only shows it to people who engage. If you found value in this, subscribing is how you tell me to keep going. I'll have a follow-up video tracking COMEX registered inventory and the COT short position over the next 2 reporting cycles. Because if those numbers start moving the way I think they're going to, you'll want to have seen this video first. The ratio is at 60.8. The shorts are piled in. The vaults are draining. You now know what that means. Take care of yourselves out there.